All right, coming straight out of October 29th. This is the video like it takes 30,000 to a million. This is King Slav or straight out of bed Slav. Take your pick. I don't got time to dress up, all right? So we're going morning style. I wanted to make this video before I have to leave the house. So I want to show you the account since I had a monster day yesterday and it was kind of good news. Apple beat on earnings, and it took the market quite a while to react actually properly to the news. I was looking at the aftermarket movement post Apple numbers, and it was incredible. The thing was like going down. It was down like 2-3%. I'm like, am I reading the same numbers as everybody else? What's going on here? So enough of staring at my morning face. Let's go into the account here, and I'm still sitting at almost 175,000. Believe it or not, that is an improvement of, quite a lot over the past month. I was as low as 142. So quick math, that's like, $33,000 higher. Just in the week, 18 grand recovery. Year to date, all these numbers still don't look too great, but a lot better than they did just a day ago. It's crazy. So year to date, let's just review the account, and I'll compare it to the S&P 500 and see where I stack up. So going into the options first, these are all the list of the options. I'm not going to read through all of them. You can make your own conclusions based on what you see here. I did some plays. I may have to go into the history so you can see what I've done here with Verizon, which is not showing up on the options because I had an execution, and not the kind where kings cut off people's heads, but the kind that Robinhood executes on your behalf whenever you play around with options. So these are it. Feel free to pause the video player at any moment to try to find out the exact position. All the information you might need is in this little box right here, so that's all you need. The numbers on the right represent the daily change in value and percentage. These are the equities. The list is looking quite larger. Apple sitting at 700. I had bought a few shares, but I sold them just in case Apple drops down again. I can pick those shares back up. Actually, I can't because I spent it on a stupid play, the SQQQ. Don't ever buy that. Like, that's actual advice. No, nothing you hear is actual advice. Don't be fooled. But anyways, so Apple at 700, Realty Income 824, Main Street Capital 100.15k shares. Everything was good. Everything was big. Everything was up. However, not all of it will survive because options. All right, these last two positions, they're just really insignificant. It's not really even worth looking at them. It's just mini plays. It just ties up some extra cash. So $700 here, which I shouldn't be doing because I'm paying interest on them, even if they're small, and I don't want to be paying interest. I should be nickeling and diming this thing, but together they're just over $1,000. It's like $1,100 as an investment, so it's not really that big. Actually, I think I can probably do it by your equity. Yeah, you can see how big the positions are by just pressing this tab here on the right. You see that Apple's way above and beyond everything else. So is Smith and Wesson at 96,000. $1,100 in comparison to those positions is not that big. I do realize that it's still a lot of money. Like $1,100 is a serious amount of cash. Okay, so going to the investing tab as usual, I'm commanding an all-time high, probably somewhere around here, either 325 or 320. Near all-time high total value of the account, including the margin. So that's not something to be proud of. It just says that I've pulled out a lot of margin. You can see that it's at 45.66%. You normally have to double that number to find out how leveraged you are. So I'm nearly 100% leveraged, 90% leveraged or so. Here are the positions based on total equity. For number 1 is Apple, number 2 is Smith and Wesson, number 3 Realty Income, Main Street Capital, etc., etc. Total return, Apple's number 1, Realty Income number 2. Everything else is in the red. Look at this redness. Smith and Wesson down 14,000, Paramount Global down 11,000 and a half. So not too good. The thing about these positions though is that it's not as bad. Okay, maybe I shouldn't show my face. Let's go. The thing about these positions is it's not that bad as it looks, because let's take the Smith and Wesson position at the moment. So it's sitting at 1130. That's actually quite a recovery since just a week ago. Actually, let's see how much. Yeah, see, look at this, up 8.76%. But it's not actually that bad because I'm collecting a lot of money from selling call options. Actually, so I'm at a loss at the moment. However, I sold them for like 5 cents each. So that's $5 per contract times $85. So that's how much I originally collected just for putting up my stocks as collateral. But not only that, I collected some premium on the way down, right, as I was buying the shares, because I bought them through Robinhood executing put options for me. And so it's really doesn't it's not as big of a loss. It's probably more like $10,000 than 14 at the moment, but it could get bigger, it could get smaller, who knows. Currently, if Smith & Wesson reaches $12.50 by November 18th, I will be forced to sell the position at a slight loss, but it's probably going to be about even considering the premium that I've collected. You can see that the average cost is almost $13 per share, average purchase price, but that does not take premium into the account. So we have to know that. Portfolio diversity is a third of the account. It's crazy. It's nuts. The other one that is in the same similar position is Paramount. Paramount has a high average purchase cost of 28.73. I mean, I was one of those people that thought the company was undervalued at 30. Blame me for it. But down almost $12,000 on that. Options positions are collecting me, like, I don't know, $200, and this one is expiring on 12/16, so December 16th. All of the 1,200 shares are stuck as collateral instead of stock as collateral. Anyway, that was dumb. All right, so back into the account. Let's do a little relative comparison. So one day, 7%. It's a monster day. I mean, it's crazy. So I'm pretty excited about that day, mainly due to Apple, really. But all my positions were up virtually, more or less. The 1 week performance 11.73. 1 month is 15.83. So these three time periods are looking a lot better than they did just last week. It's incredible turnaround. I hope it's not done yet. I'm hoping that there's more upside, and I think there will be, and I'll tell you why later. So the 3 months is still looking bleak. It's at minus 13%. I don't think I'm beating the market on the 3 months chart. But the year to date, I think I'm beating the market in the 1 year chart also, and of course the old time chart, which is everybody's favorite to look at. I started investing here in August 28th, 2018. So since then, I'm up about 130%, 140%, which is a lot better than the market. I might have almost tripled the market in that time period. So we'll take a look when we go to the S&P chart. And we're going to take a look at the S&P through the SPY, okay? S&P means Standard & Poor's. S&P 500 means is basically the top most profitable companies in the United States by size. The SPY is an ETF that tracks the S&P 500. So SPY is just a ticker symbol. ETF means exchange traded fund. It's just a fund that collects assets and tracking the top 500 companies, most profitable, largest companies based in the United States. So now that we got that done, on the 1 day chart, the S&P was up 2.37%. We're going to ignore the after hours for now. And that compares poorly to my 7% gain, so that's cool. 4% almost on the week compared to my 11s and not winning. And the 1 month chart, I'm barely winning by like 3 or 4%. 3 month chart, the S&P is winning. So I'm down like 12%. The S&P is only down 4.2. On the 1 year chart, I'm winning. The S&P is minus 14. I think I was minus 6. So definitely looking up for my account on the 1 year chart, and of course the 5 year chart I'm winning as well. So really the only problem is the 3 month chart, and that's due to Apple's quick descent from grace right about, let's take a look at the Apple chart. It just coincides with it. Right about from here when it was 174. Okay, 174 went all the way down to like the 130s. So that was bad. But now it seems to have formed a higher low. There was a low here, and now there was a low here. And that's good news. And the market formed a lower low. So it seems like there's a bit of a divergence, a bit of confusion between the market and Apple, which is to be explored. Furthermore, why? That was the most unique furthermore because I have nothing to say afterwards. This is the account. Oh, this is what I was talking about. So what's going on here is there's a very obscure little law that's going to go into the effect. Okay, I don't know many people will know about it, but share buybacks, which are responsible for the majority of stock price gain in the U.S. markets. That's one of the reasons U.S. markets always go up. It's because there's a lot of share buybacks. Well, that's one of a few reasons. I mean, if you didn't have the cash, you wouldn't be able to do it. But anyways, that's a whole different discussion. Stocks go up because share buybacks, at least some part. There's some responsibility there. Anyway, stock buybacks are going to be taxed at 1% next year. Now, 1% is actually quite a big number when you're talking about these type of like little marginal percentages. The stock market, whether the stock market gets 10% or 11% per year, is a really, really big deal for asset managers, for compound interests, type of investors, compounding investors, and for a lot. It counts for a lot actually, and what that's going to do is it's going to change the behavior of the people who are deciding how to allocate capital within their companies. Some people are going to do, still cash. They're still going to do stock buybacks. Some people are going to disperse more money through dividends. Some people are going to hold on to the money. I would not be surprised if many companies started holding cash instead of trying to disperse it to shareholders. So that's going to have a very interesting effect on stocks. I don't know what that effect is going to be, but I know it's going to be interesting because it's going to be different. So look out for that. One thing that might happen here is I'm doing like a little minor prediction here, is that come November when I think the market will bottom. So I think there's going to be another leg down, but there might not be. I could be wrong. I mean, it's fine. But come November, I think that people, or even starting now perhaps, people at high-powered corporate positions are going to start making decisions to do their last little hurrah of stock buybacks because they might not be able to do it next year or the year after that. It becomes a little bit uncertain. Maybe perhaps the Republican government, if they get elected, will reverse the decision. That could happen, but this 1% rule could stick around for quite some time. And not only that, but that 1% rule is most likely going to have an effect on inflation, because if money gets stuck, this is a good point. If money gets stuck on corporate balance sheets, see if you follow me here, right? That money is not getting dispersed to investors. What do investors do with the money? Well, they either reinvest the money or they spend it. So by definition, if the money gets stuck in corporate balance sheets, it's going to decrease volatility. I'm sorry, not volatility. What's the word? Velocity. It's going to reduce velocity of the money supply. And so less money is going to be turned over through the economy on a specific given day. And that's going to have an effect of lowering overall pricing of products. Okay, or as we call it nowadays, inflation. So look for that effect. Number two, if the companies decide to return money to shareholders through stock buybacks, etc., it's going to get taxed 1%. That 1% is straight money that's being removed from circulation and placed into the nether, okay, into the abyss, because that's what happens when taxes get collected. I don't know if you guys knew, but when taxes get collected, the money gets destroyed. Like literally. They don't go towards the payment of whatever. They actually get destroyed. Hear me out. Everything that the government spends is on a credit card. Okay? It's true. Every single spending is on a credit card. They have a credit card, and all the bond holders, everybody who holds bonds, including the Federal Reserve, is basically their creditor, okay? So they spend on a credit card, and whenever the money comes back, it gets repaid and destroyed, okay? The reason it gets destroyed is because they pull money out of nowhere, right? So the Federal Reserve is an infinite bank, so they pull money out of nowhere, and when they return it, it just goes back to nowhere. It gets destroyed. So it's a really important point. It's actually a way to reduce inflation. So this 1% tax, it might have the effect of reducing inflation, which is also bullish for the markets, by the way, because of a whole host of chain of events, which means, stopping of increasing rates, etc., and everything that follows from that. So it's an important point. I think this law is going to definitely have an effect in inflation. We're going to see it in the stock market. What kind of waves it's going to make and how, at what speed, I don't know. But it's definitely going to be an interesting time period ahead. Okay, so hopefully that knowledge helps you out a little bit. And that's the review of the account. Maybe I'll make a company video over the weekend. We'll see if I have a cool one to review. If you have an idea about a company that I want me to review and do a shallow dive on, post it in the comments, and I'll try to work on it during the weekend. If not, we'll see you next week. Hopefully you all made even more money than I did, although that's going to be hard this week because I made 7% in a day. So